All right, so today we're going to be talking more orientated around trading and consolidation because last week there was a ton of accumulation, like an insane amount of accumulation where price would just not deliver and instead would rather accumulate large periods of time. Now, trading in accumulation or consolidation tends to be one of the most hardest forms or times to trade, especially because price isn't delivering, right? When we participate in a trade, ideally we want to catch the expansion of an hourly candle. At least that's how I take it for myself. I'm always trying to catch the expansions of the hourly candle, specifically the 4 hour one. But what happens when these 4 hour candles just have no interest in expanding? Well, we tend to see how price will just make wicks through wicks nonstop. Now, these sort of markets are deadly. They are markets where price will just seek to create liquidity and make you liquidity. So unless you're an experienced scalper, it can be quite dangerous. Now, what can you do to avoid this is very simple. If you guys go back to when we did our A plus framework, for what trades are A plus and what trades are C tier, the main thing is that every time frame wants to be in sync for a large expansion for it to be an A plus trade. If the time frames are not in sync, that means the quality of the trade decreases. Now, the biggest clue to know if you're trading in an intense accumulation is honestly just hopping between the 5 and 15 minute time frame. If you go between the 5 and 15 minute time frame and you see price unable to expand beyond the highest point and beyond the lowest point, that's accumulation. So for example, right here, we noticed that this was the highest point in the 5 minute time frame, and we noticed that this was the lowest point. And no area or no moment the price was able to break out of this area right here. So this is how we can perceive the accumulation. Price is not seeking to deliver, it's more seeking to take out internal liquidity before trying to expand first. Hey CTL, I'm just doing a quick little class here of accumulation and consolidations before I wrap up my weekend. Now, ideally when prices like this, you want to be mindful that you can't overhold things, especially because you don't have that guarantee that price is going to start seeking the actual external liquidity as the draw. So it's likely that it takes out internal liquidity and immediately push right back up. Now, these sorts of movements are really rough if you're like a risk reward trader, right? If you're not a scalper, these can be deadly, and these are the type of situations where it makes you doubt yourself a lot too. Because when we enter a trade, and let's say the trade fails, you think, oh, okay, I was wrong. Perhaps it's going towards the opposite liquidity. Let me flip the position instead, which is something we do often, right? You guys see me flip positions, you see JD flip positions, and you flip, and then you're wrong again. Okay, maybe it was just a stop rate, now you tell yourself, and you enter again, and then it ends up being wrong again, because price isn't seeking to go anywhere, it's just seeking to go sideways. It's seeking to just generate liquidity and make you liquidity at the same time. Now, the best recommendation is really patience. Wait for price to break out of these ranges that it makes. So for example, this 5 minute one, you could wait for price to break out of that before looking for a trade, because it's not an ideal area to be trading within or an area to be putting yourself in danger. Because you got to remember that the idea behind this game is self-preservation, right? We want to be able to preserve ourselves long enough so that when these hard markets are in play, you're not blowing your account. You're not blowing weeks of profit in one bad day, right? You want to be able to sustain yourself so that you can preserve to the point that when the market is easy again, bang, you catch a winner, bang, you catch another one, easy peasy, and you accumulate those gains, right? For example, this week, I didn't crash out. I followed my rules, and unfortunately, I was wrong several times. I ended up having a full red week. But despite having the full red week, I didn't blow my accounts. I still have plenty of space in them, so that if next week is better, I'll just make back everything that I lost super smoothly without trouble. And that's the thing with these prop firms. These prop firms, the reason they're so profitable in the first place is because people don't know when to stop, or they don't know how to survive a red week or a red day. That is how a lot of people just completely fail in this business and don't really make the most that they could potentially do, because they don't give themselves the time to survive the bad stuff to enter the good stuff. And when they're entering the good stuff happens to be an evals or happens to be recovering already losses. This is another example right here. Price, in this case, we could say that we were accumulating, pushing downward, a high resistance liquidity run where price is pretty much not trying to expand towards the jaw, but it looking like it is. It's just grinding down. This is another similar situation. If you see wicks like this, up and down, with no intention to deliver lower, but it keeps, let me rephrase that. Every time it takes an internal liquidity, immediately pops right back up, that's a sign that the market right now is in a phase of just accumulating liquidity. Ideally, when price sweeps through internal liquidity, yes, you take partials, but it's also a sign that, okay, if it closes below it, we can expect more continuation for the external. And every time price took out an internal liquidity, here came right back up. Here came right back up. Here came right back up. Same thing with the highs, took this out, came right back down, non-stop back and forward. So another thing to just keep in mind, if you notice while you're in a trade or if you're looking at trade that price is just aiming for internal and immediately reversing, you can consider that accumulation, consolidation. It's not trying to go for the external part yet. And unless you're scalping, that's a moment where you take a step back. You patiently wait. Let's say you start the day though, right? You wake up at whatever time, or you just got done with work and you want to take a trade. This is why looking through the 15-minute time frame and the 5-minute is always the best for your mid time frame gauge. If you look at the 15-minute time frame immediately and you see all of these wicks right here, like this, oh, okay, price is really choppy. You might as well just be patient and wait for an expansion and not even bother engaging. So that's like your little clue right there. Ideally, you want price to be smooth, fast, and efficient. For example, right here. In fact, I think this was the trade that you took, CTL, in the pre-market, which was that 15-minute 2022. So when you want price to see, or well, actually, you want to see price do these sort of models and deliveries where they expand through internal liquidity and show continuation, right? If we compare here and this, what is the difference? The difference between this right here and this right here is that this was only going for internal, no external. Here, it took out one internal liquidity and was already prepping to start the expansion. And you can see that after it took out this one, it continued, because now it was delivering for external liquidity. So if price flip-flops after taking internal many times, it's accumulation. But if price after taking our internal starts to expand and deliver, you can expect it to go for the external ones here and here. And ideally, you want it to be all structurally, right? You can see the clear difference between here and here. This was delivery and took internal liquidity down here, stop rate. Took the high up here, but had a close above, market structure shift. What do we have right here? Difference. Came right down into this PD array. Okay, let's say it could continue, right? Wicked all the way down here, bam, came down again. Came up again. But it's not really going for anything. It's just back and forward, back and forward. Now let's go to another moment, right? Right here, for example. So you could argue, okay, let's say S took out the low, we made a shift, a stop rate, Then we came up here and made the shift. Excellent. Now, ideally, you could expect the same thing that happened here to happen here based on the structure at hand. You wait for price to kind of push down into your area for it to expand higher. But in this case, it's accumulating in this range once more. So this, although it has similar structure that looks like a 2022 model to expand higher, this one's accumulating a lot more rougher in a tighter range. What I mean by a tighter range is you see that this one is this wide. This one is this wide, much more smaller. And you can identify clues of that as well by switching time frames. If we look at the 5-minute time frame, you can see that this is so much more tighter, and this one is a bit more wider. Now, both of them are accumulations. The tip here would be ideally to not touch any of them unless, let's say, you get a good entry point. Now, for me, if I wanted to go long here, I would want to see price retrace into a PD array like right here first. Right here, it did end up retracing into this PD array and respected it every moment, so this one's a bit different. But within this tightness right here, you do not want to participate in any of this. This is just, it wants to create as much 1-minute mess to stop as much people as out before doing any sort of movement. And that's why ideally, when it comes to the 1-minute time frame, you see me use it all the time, you see JD use it all the time, but the 1-minute time frame is really what you want to rely on for entries. You want to use mid time frames and high time frames for your narrative, for your decision of where the potential draw is. Because looking at the 15-minute time frame earlier, right, you would predict that, okay, this here is a lovely 2022 model. Despite that it's accumulating a bit right here, it practically looks like it wants to expand higher, so I can go into the 1-minute time frame and look for a buy model to participate for the move up here. But if you look right here, okay, this is chopping. We have our PD array right here, but we haven't come into it. Let's see the 5-minute. Super tight. Nothing really here interesting for a potential long. So there's the difference. There's nothing here, but it is super tight consolidating. Here there's a PD array. Now if you go to the 1-minute, you can see that it's very messy. Now this is full of just inducement. Imagine going long here, price pushes all the way down here, stops you out. You go long here, price pushes all the way down here, stops you out again. You don't want to rely on the 1-minute right there. And if we go here, it's even worse, because here price is practically doing nothing, a whole lot of nothing, back and forward non-stop, stopping people out. The key thing would always be to wait for after the expansion, or to get that clear manipulation so that you can participate in. But the main getaway would be, you want to be super patient for these to break. Because if you try to participate in this, you can see this is super messy. And even if you're an experienced trader, you're going to get hurt trying to trade things like this, or forcing a trade into this. The game here is really to be patient and wait for things like this to end. It's way better and preferable to wait for it to end and then to participate. Or for example, right here, I'd say that this was a great trade. You could wait for this to end, and once it had its breakout, you could go, okay, now that price broke out of this accumulation, let's say I don't even participate in the fair value gap, you just waited for the accumulation to break. All right, broke out of it. Now I can look for an entry model to go for the external liquidity. So let's see if at any point after it did the break, was there an entry model? Oh, there were plenty. Right here, this was another 2022 1-minute model. This was a stop rate. This was a shift. And this was a retracement to the fair value gap. This happened right as price was breaking through the accumulation area. So that could have been your entry point for the expansion to high time frame liquidity. So you avoid all of this mess, and once you get the confirmation that price wants to go, you participate. You could have participated as well here, or you could have participated right here before price went for the external liquidity. After price took out the external liquidity, okay, then you're kind of chasing unless you see some structure supporting the move that you're looking for. I'd say those would be my tips with navigating this sort of choppiness and how to approach it as well. The approach will always be one of patience, one of waiting for it to finally break, and then taking action, while keeping in mind the 15-minute and 5-minute time frame for when it might potentially end. And of course, if you see wicks everywhere like this, it's way better just to not engage. If you're experienced enough and you're confident enough in your system that your system has reliable outputs in that area, go for it for sure. But if you know that your system is not going to have a good time, just wait it off. The market is always here. The market will always give different opportunities. You don't necessarily have to engage here. You can literally just go touch grass, and when you come back, maybe there's a model. If there's a model, you take it, and if there's not, all right, you end your day with no trades. But that's something you have to start coming to terms with, because again, you want to survive the rough times so that when the easy times come by, you're making a lot of money and you're making back the loss and more with easy trades, less stress and less anxiety. Is there any questions? Now, of course, this is recorded as always. It is going to be a short class, so not much to digress, but you guys can review it whenever you want when it comes to the choppiness or just how to approach accumulation. Remember, guys, the market moves through phases: accumulation, manipulation, and distribution. As traders, we want to really take action in the manipulation and distribution phases. That's how you see me take those big trades with 100-point swings, or you see JD or CTL or other of the admins take those large expansions, because we're always trying to catch the manipulation or distribution of the moves. We're not trying to mess into the accumulation. And you can see that there's a lot of people online that suffer from that. In choppy days, they'll post their losses and be like, oh, I lost. Well, yes, but you could have lost in a better way by simply not overdoing yourself or not trying to force a trade. Now, I see that a lot of other people are joining. We are at the end of the class, but don't worry, it was recorded and it will be posted soon. I see that Darius is sending a text. Let's wait for what he says before I end. Okay, so I assume you mean this example right here. So how do we determine if it's truly breaking out of the range? So I like to measure it through the swing highs and the swing lows in the first leg move that it does. So in this case, this would be a swing high and this would be a swing low. If this is the area that price has been chopping in or accumulating or consolidating through a large period of time, unable to break through the external and internal liquidity, this would be the area that you kind of don't want to engage in unless it breaks above it. Now, sometimes there's going to be clues that it's going to break when it's around one of the borders. Now, ideally, you do want to be careful, because if it's like, let's say here, or let's say here, there's a chance that, let's say, it does this and then comes right back down, right? Or it does this and comes right back up. So you want to be careful. But there can be clues showing that it's going to happen early, right? In this case, the clue would actually be that 1 minute 2022 model right here, that it's going to break through it. But if you want to be really careful, just wait for candle closes above the range. So at what point would I say, okay, it's finally broken? I would say the moment this second candle was formed right here. The moment that second candle was formed, you can see it's quite firm and everything. It's right above the range. It's looking firmly like it broke out of it. That would be enough for me to be convinced that, okay, it's ready to finally go. And then you look for the 1 minute entry model in that area. Let's say in comparison, let's use this one as well. So we had this range right here. This one kept going wider and wider. You could say from the swing low to swing high right here. Right, this was full on accumulation, Eventually price closed above it in this candle. So right here, I would say, okay, it finally broke out of the accumulation range. It's going to go for buy side liquidity up here. Let's say all the way up there, you could say. So you go into this area and look for a 1 minute time frame model to look for longs, right? Assuming the price is going to go up there. Now, in hindsight, right, we know that price did not do that. Price just came right back down. But after seeing it break, let's see, do we have any 1 minute model in this area that says that longs can work? We tap the fair value gap, pushed up, pushed lower, came lower, 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 top the volume imbalance, pushed up, lower, lower, lower. Nothing really here happening. Okay, so this is why the 1 minute is like an entry model. Despite that it broke out of the range of the consolidation right here and closed above it, and you can assume the price is going to go higher, at no point did it make any sort of 1 minute model to give you that ignition for delivery higher. So easily you could have been patient and just avoid entering anything because nothing appeared in the 1 minute. So now you know, okay, came back down, maybe this was just manipulation. Let's see this area right here. Okay, this is a 1 minute entry model where you could have participated where price, after it closed above, could lead to delivery higher. Do you see kind of subtle differences between here and the last one, Darius? How can I explain it better? Let me draw it out here. So when we do this, blah, 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 messy, 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 when we expand, depending on how firm, how strong we expand and close above it, you can determine if we're finally breaking out. So in this case, let's say it was a firm candle close, no wicks, no nothing, just a firm close above. If I see that in the 5 minute time frame, I would consider it's breaking out of the range. Once it does this, I go into the 1 minute time frame and I look for a 1 minute buy model to show me that it in fact wants to continue going higher. Because yes, it can break out, but the continuation is where you want to find the key thing. Now, if you see the 1 minute entry model, you participate in that, and if you're wrong, okay, you wait and reevaluate things. But ideally, that would be where it would be mostly correct, in my opinion. Now, comparing this here, this would be one of the potential entries, or right here. And you can see that these two in this area is above this box, above the breakout box. And if we compare this one right here, price did break out, but we don't really have any doable 1 minute entry models here. I'd say you could argue that we could enter the long in this volume imbalance, but that would have been a stop out. That would have stopped you out and would have failed. So those would be kind of the comparisons. Any other question? Now that could be an interesting point, Imont. In the scenario that we are accumulating and we do like a break and immediately fails and starts looking for the opposite, you could try, because it could be a power of 3. So it could be where this was accumulation, this was actually manipulation, and we might distribute lower like this. So you could look for a short. The thing would be that you would have to be a little bit more careful with the assumption that it's not going to be an AMD. So what do I mean by that? Let's say you short this leg right here. You have to be fully mentally and visually prepared that maybe it just wants to either come back to the range. And if it wants to come back to the range, this is how it's going to look. So it broke out of the box, but it only took out internal liquidity and now it's back in the range. So it can either be where it takes it out, comes back in, or it fully breaks out and does the distribution down lower. So if you do participate in the short, the moment this comes back in or fails to expand any higher, then you want to be mindful that the moment it takes out internal liquidity, you could raise your stop to break even, you can scale out, but just be prepared mentally that it's either going to come back into the range or it's going to break out and actually do a distribution. You could try waiting for it to break below. There's been times where that kind of gives you the extra confirmation. So yeah, you could definitely wait for, let's say, something like this. It broke out, retraced, continues. You can definitely wait for something like that. In fact, I'd say that would be best, really. All right. I hope you guys enjoyed the class. And I will see you guys next weekend or Monday. I'll explain it to you later, Birdie. Have a good one, fellas. Bye-bye.